Everybody, it's Jared with Exponential Wealth. Thank you for joining us today in another educational video helping new traders and investors like you navigate through the markets. Exponential Wealth is committed to providing you with helpful information to cut the huge learning curve. But before we begin, just a little disclaimer. All information provided by Exponential Wealth is for educational purposes only, and all of our content is not financial advice in any way, nor are they recommendations for any investments. And so without further ado, let's get started. So today's video is going to be on the topic of following smart money. We are the little fish in the big pond. So first and foremost, let's define what smart or big money is. So smart money is the institutional investors, right? These are pension funds, these are hedge funds, these are banks, central banks, and professional financial professionals who work for a bigger company other than individually, if that makes sense. These are the entities that move the markets. You see a stock go up, you see a stock go down. It's most likely, maybe like 99% of the time, going to be because of these players in the market, the big fish, right? They buy, they sell, and they trade in the billions, if not trillions of dollars. Okay, so on the other side, who is dumb money, right? Don't take offense to the term. This is just the nicknames, I guess, that we were given. So who is dumb money? That's basically you, me, retail investors, Robin Hood investors, as CNBC would like to call us, professional individual traders who, have their own accounts. They trade for themselves, not for a company. These people or these groups cannot really move the markets in any significant way, right? If you know the story of David and Goliath, we are David in this case, but we don't win. So if you don't know that story, Google it. It's a very interesting story. Like I said before, we are the small fish among the bigger fish in the sea. And something I want to point out, it's called having an edge. But what is technically having an edge, right? So if I could just have a little side note here. If I want you to think about the casinos, right? So think about American roulette, for example. Who has a higher chance of winning in American roulette or any roulette in general, right? The casino's odds are slightly higher than 50%. It's probably around 53%. The gambler's odds is less than 50%, and it's around 47%. So who has the edge? The answer is a casino, right? The edge is defined as having a slightly higher probability of success. A huge part of trading and investing short term is actually just statistics and what's the most likely thing to happen. The more key factors that you can add that support your trading thesis will actually help you gain a better edge relative to the rest of the market. So if you think about just using the casino example, if you watch the movie 21 where they play blackjack, right? So the whole premise of the movie is they're counting cards. And this actually is a legitimate thing. If you guys didn't know, you can actually count blackjack cards. It does give you a higher edge, a higher probability of success, and therefore a higher chance of making money, which is why they got kicked out of the casino and beat the crap out of, right? Because the casino doesn't like that. They lose money. So how do you beat smart money? This is a big secret, right? Everyone wants to know. You can't. So don't even try. So what's our edge as dumb money? If we can't beat smart money, how are we to win? The best thing to do is going to be following the smart money. Now, just as a little example, if you've ever seen a shark, you've seen those little fishies. They're just hugging the shark and swimming right next to it or on it. Is a shark eating them up? No. They both benefit. In this case, it's kind of different because smart money doesn't always benefit off the dumb money. Usually we suffer when they benefit. So not too similar, but identifying what smart money is buying. This is how you follow the smart money, right? You find when the smart money may be buying. You understand how smart money positions into stocks. Knowing your advantages as a retail trader versus smart money. A key advantage of a retail trader, if you think about it, these funds, these smart money, they're trading with millions and billions of dollars and trillions of dollars, and they can't just place a trade. If they want to exit a trade, they have to slowly scale out. If they want to enter a trade, they have to slowly scale in, or else they're going to shoot the stock price up or down way too fast. And that's going to affect their potential to get in as well or get out. So how does smart money buy and sell stocks, right? So this is most of the time, right? You're going to have an accumulation phase. You're going to have a markup. This is when the price starts to increase because they're accumulating a lot more shares of that stock over time. And it's not just one fund or one institution, right? Once multiple funds and multiple institutions start piling on to one given stock, you're going to have people fighting over a share, which brings the price up. So after the big move, obviously these big funds, they're going to want to take profits, right? They're going to be up a lot of money already. So what they're going to do, they're going to have to slowly scale out, which is the distribution, right? And who do you think they're distributing to? Who do you think smart money is distributing to? They're distributing to the dumb money, right? And just like the markup, there is the downside. And after they have cleared their positions, usually they, since there's no more real big buyers in the space, no more big fish that want to buy the stock, usually the stock ends up coming down as selling overweighs the buying. And this is going to happen over weeks, and it can even happen over months. This is what you call position trading. Okay, so sector rotation and rebalancing. So funds and institutions, they have a certain portfolio that they have to manage and kind of change every now and then. They have to sell a little of this, buy a little of this, make sure they're well balanced. And they have to also meet their investors' needs or whoever they're working for. So this is just a little example, right? This is going to be a little portfolio, fake hedge fund portfolio I made up. Let's just pretend it's $1 million for simplicity's sake. Obviously, they'll have way more than that. But let's say 30% of their portfolio goes to healthcare, 20% to technology, 15% to industrials, 10% to hype stocks, and 25% into value stocks. And those are the values to the right. And I want us to focus on the hype stocks here, right? They only put 10%. 10% of their portfolio, not that much. This is only $100,000 out of our fake, $1 million portfolio. It's not much. It is kind of just a gamble. If it works, if it doesn't, it's okay. It doesn't hurt us. So in this example, let's pretend this is just an example. This is not going to be real world. This is not going to be actual what happens in reality. So let's pretend every other part of our portfolio stayed the same. It didn't really change. So 0, 0, 0, value stock 0. But let's pretend the only one that benefited us, right? Our only good investment was the hype stocks. And we got a a return of 500% for the quarter, right? 500% for the quarter, and we only put in 10%. We only want 10% of our account to be hype stocks. But since we got such a big return, now I want to take your eyes over to the right side of the screen. Now our portfolio has grown from $1 million to 1.5 million because of the hype stocks, right? Healthcare stayed the same, technology stayed the same, this stayed the same, and value stayed the same. So the values are the same. But what changed was the 500% return we got in hype stocks. Our 100,000 investment changed into $600,000, right? So in total, now our portfolio is 1.5 million. This affects the pie chart, right? This affects the pie chart that we have here originally. So as you can see, I noted that by the yellow percentages, right? So we used to have 30% of our account, 30% of our portfolio in healthcare, but now it's 20%. Now 20 to 13, 15, now it's 10. Hype stocks, we only wanted 10% of our portfolio in hype stocks, but because we got such a big gain from this sector, now it's 40% of our portfolio, and that's pretty risky, and that's really dangerous for a big institution fund to have such high exposure to one sector like this, right? So what they're going to do, they're going to take this money and they're going to place it elsewhere, right? They're going to take this big weighting of their portfolio and they're going to sell some of it, if not all of it, right? They only want 10% of their account to be in hype stock, so they're going to sell the 30%, right? And that's a lot of money if you're talking about millions and billions and trillions of dollars. So what they're going to do, they're going to find maybe underperforming sectors, right? Solar sector has been selling off. Energy sector hasn't been doing too good, right? Retail has a good risk to reward, for example, right? So they're going to take that money and they're going to allocate it into other sectors. So this is the rotation that that I'm talking about. They can even add, to their own portfolio. Let's say they want to increase a holding in healthcare, for example, right? These institutions, they don't like to stay in cash unless they have to, right? They have to have their money working for them, or else their investors or the people that's providing them money, they're not going to be making money in cash. So they're going to have to place that money in an asset or a sector that will give him a good risk to reward ratio. So what happens when there's no sector rotation, right? What happens if money doesn't move around into different sectors? Money flows out of the stocks because they have to sell it and into cash, right? So this, for this example that I have on the screen, this is the 2020 coronavirus crash, right? This is the S&P 500, top 500 companies of the United States. We had money flow out of everything, and I mean everything, right? Everyone got scared, so look what happened. We had our fastest crash in the history of America. And now 2020 coronavirus crash, this was a very extreme case. As you can see, I think we crashed about 40% in less than a month and a half, I would say. I'm not too positive on that. So now every asset class, so this is the S&P 500, top 500 companies, right? So now this slide is going to be the different sectors, right? So you have like technology, you have industrials, you have the solar, you have the financials, right? So you have different sectors here, all looking like the same thing, right? They're selling off, selling off, selling off, selling off, selling off. So there's no money that's rotating into any one of these, right? All the money is moving out of each one of them. So like I said, that this coronavirus crash was a very extreme case. I'm going to show you what the not so extreme case is, right? So on your left right here, this was a coronavirus crash. You had a consolidation here. As you can see, we kind of just went sideways. right here too in September to November last year, which is 2020. We just moved sideways. And then we had a most recent one here in 2021 in February and in March, just sideways, right? So this is what happens when money tends to move out of sectors, or very little money is rotated into a specific sector. Because the S&P 500 is such a big index and made up of so many companies, you have to have multiple sectors all increasing at the same time for this whole index to increase as well. If you don't, you're going to have times of mini consolidations like this where maybe one sector is strong, but the other sectors are selling off because they're taking profits on the gains that they got from that. So before you even really invest or put your money in, right, you have to know your goals. You have to follow the big money. You have to know what you're investing in. If not, you're setting yourself up for failure. So these are just examples. I actually follow a stock market group that actually has almost 200,000 members on Facebook. I would say 99% of them, 99% of the people in there are probably fairly new, especially with how many people have gotten into investing in the past year or so. So these are just some examples, right? You have this person right here asking, why is the stock market, what's going on with the stock market? His or her portfolio is red, and it's just been like that for the past 2 weeks. This person's not doing too hot either. Lost $2,000 in the last 2 months. This person, losing $2,000, doesn't think the stock market will go back to normal anymore. They sometimes blame the president, blame Congress. This person, is going on a complete rant, saying the stock market's a complete pump and dump. This is what happens when people are, don't know what they're doing. They're just throwing their money into whatever's moving up. But at the same time, you have these people complaining about their portfolios, right? At the same time, you had the S&P 500 closing above 4,000 for the first time, all-time highs, right? Lifted by tech. We close out the month of March, which was one of, a pretty rough month, but we closed one of the best months since November in the S&P 500, right? So you have a sort of extreme polar sides here. You have the people who are investing in certain stocks that aren't even moving, and then you have the whole market making all-time highs. There's some disconnect. So let's take a look at some of the hype stocks that everyone was being a part of the past 6 months. But let's view their performance so far in the year of 2021. Here's a famous stock that everyone likes. It's the Tesla of China, NIO. I've highlighted here in the red box the last, starting maybe February to March, maybe the last 2 months, I would say. So just take a look, take a mental image of what this looks like, right? We are downtrending, obviously. Going down, down. NIO. Next one is Plug. A lot of people liked, the EV sector. Had a nice run up, but this is when people realize that, stocks don't only go up. So you have the big institutions taking profits. They're selling, they're rebalancing their portfolio into something else. You have Palantir, another great hype stock that everyone loves, right? Same time frame, 2021, boom, down, straight down. It does look like it's bottoming here, so that's a good sign. Next, we have CCIV. This is the Lucid Motor electric car company. Big sell-off, right? Just big sell-off here. And now we're probably basing. So that's a good sign, but if you bought up here because your friends told you to, where did that get you? you're probably down a lot of money right now, like the people I showed you in the Facebook group. Next, we have Clove. This is a SPAC, a SPAC that Chamath Papalatia. I'm sorry if I butchered his name, but this is one of his SPACs that he was advocating for. If you were to buy it up here, like, you would have been down a lot of money already. It's showing signs of a reversal, which is good. But like I said, know your goals. Are you investing in this company for a long time or the short term? So that kind of ties into my next slide here. Know your investment goals. If you're investing for a company in the long term, why are you going to look at your account every day, right? If X and Y stock is supposed to be a futuristic stock that's going to, run the world 5 years from now, why am I going to look at the stock every day and see how it's doing, right? You have to do your research. You have to follow the company. If the company's fundamentals are exactly the same, but the stock price has come down, it should be fine, right? Revenue is still growing. Are they still selling products? How many cars are they selling? Are they still selling the same amount of units? Are they actually increasing their production, right? A lot of people are in NEO right now, and obviously NEO had a fantastic run, but it has, not, things don't just go up. Now profit taking is happening, maybe a little too much profit taking, but if NEO as a company has not changed fundamentally, if they're still the same company, the same great company that you believed in, if you bought NEO at $50, then you would love NEO at 35. You would love NEO at 20, right? If I could have Tesla drop to $5 for any reason other than change, if for any reason other than like changing their fundamentals, like, I would totally buy the stock, right? Even if it crashed that low, because that Tesla in the long run is still going to be the same company. So investing for the short term, how about investing for the short term in swing trading stocks, right? So you want to focus on where the strength is, and the strength is where the smart money is putting their capital, right? You want to be the small fish that's following the shark. You don't want to get in their way. You're not, you don't see the small fish trying to tell the shark where to go. You don't see those small fishes get in the shark's way trying to steal their food, right? They lay low and they just follow, not trying to get in the way. The only like one in a million chance that's gonna happen is stuff like GameStop, right? And that is a whole new slide, a whole new video to explain. But another thing that I would, recommend here in terms of educating yourself is to focus on the stocks that are making 52-week highs, not 52-week lows, because there's a reason why stocks are 52-week lows, right? No one wants to buy it. If you're investing for the long term, though, again, you got to know your goals here, short term or long term. If you're a long term investor, this 52-week low, you gotta research why it's at a 52-week low, right? The company might be suffering right now, but if it's not, and it's just low for some reason and no one's paying attention to it, that's probably a good time to get in if it's still a good company. So where did all the profits from the hype stocks and EV and solar stocks go, right? We saw all of these hype stocks just selling off, right? All this money has to go somewhere, and it did. And the money was rotated into a different sector. And here is the same time frame, but this is XLE. This is the S&P energy sector. And during the same time frame, you had this sector actually go up, right? So energy stocks actually went up when the rest of the hype stocks were going down. This was also the same time as the February and March of 2020 market consolidation, when the markets came down a little bit. The money that was there and was made prior is now moving into the energy sector. So here's XLE, here's XOM, ExxonMobil. Same time frame, February to March 2020, 2021, sorry. We just went straight up. We're consolidating now, and we probably will make another leg up. This is another energy sector, KMI. Look at this, straight up, not straight up, but uptrending, and that's what you like to see. You want to see that strength. That means institutions are buying or have been buying into these sectors. Here's a value stock. It's not an energy stock, but as you can see, we had our February to March sell-off, and what happened? We had an inflection point, right? More or less a pivot point. It's a point at where the trend really changes. And we stopped selling off. And as the hype stock starts selling off, where's that money going to? It also went into value stocks, right? Procter & Gamble is an old-time value stock. This company isn't going anywhere. And look what happened, up. We just went straight up in March, right? And this is what helped bring the S&P 500 not only up, but sideways instead of selling off in a crash. Here's AMAT, a global leader in semiconductor manufacturing. You had the February sell-off, which didn't even do too much damage to the stock, and it came back up and it chilled out sideways for a little bit of March, and then it actually exploded to the upside because of the strength, right? When a stock doesn't go down, it doesn't continue down, that means there are buyers, and that also can mean that sellers are drying up. The bears are losing their power and their control. Here's Microsoft. Oh, beautiful. I actually made a lot of money on this stock too, because I played it pretty well. So you had the February the February sell-off into this range. But look what happened. There was no continued selling off like the hype stock. It just traded sideways. Now, if I can bring your attention to this sideways motion of the stock, and I will go back to my one of my slides. This one, right? Accumulation. I want to point that out. Accumulation sideways. So now going back to Microsoft, you have accumulation sideways, right? That means selling is starting to dry up. And it confirmed it when we broke out. At the same time, we got news, so it's a news catalyst. 2.2 billion government contract announced, right? And this is the same time that the NASDAQ, the QQQ, was also having a strong breakout. So when everything lines up like this, that's when you should have high conviction in a trade, and maybe go heavier than you would normally, because you are putting all of these key factors in your favor, giving you an edge, right? So we're going back to what having an edge is. Here's another one, Facebook. We had Facebook actually, it was actually one of the stronger names in tech that boomed before everyone else did, before Microsoft, before Amazon, before Nvidia, right? So you had your same time frame, you had your February sell-off, end of February sell-off into March, and what happened? We didn't continue selling off like the hype stocks, right? We just traded sideways. This is very choppy. You don't want to get stuck in this. So we traded sideways, and then we started curling up on high volume, especially here when we broke out and even higher. This shows you that big money, especially a big company like Facebook, smart money is rotating their money into tech stocks. So this is where the money was flowing into. Okay, so now I want to show you a free way of figuring out where to look for sector rotation. So a popular website is called Finviz, Finviz.com. And so this is the homepage, right? There's a lot of stuff going on. You have this map that shows you the different sectors, and obviously red means it's down for the day. Green means it's up. So we had not too good of a day today. I want to bring your attention here to the groups section. Here in the group section, it will tell you the different sectors, right? So you have energy, real estate, basic materials, healthcare, so on and so forth. You have your 1 day relative performance, you have your weekly performance for the past week, and then the past month, and then the past 3 months, and then half year, and then so on and so forth. I mainly focus on the weekly and the monthly, just because this is not too long of a time frame, but it's also not too short of a time frame. This will give you a good sense of where smart money is kind of building their portfolio or building their position in a certain sector, right? So the best performing sector the past month, obviously, as I showed you with Facebook, Microsoft, and AMAT and whatnot, technology was the big banger, pretty much, and that shows right here with technology. Utilities, there's a lot of value stocks in there, like I showed you, Procter and Gamble, and so on and so forth. So what I could do here, you get basic materials. It's the strongest performer for the week, right? I can click on it, and it'll give me a list of all of the stocks that are in the sector. Obviously, there's 247, so you're going to have to do some filtering through these different settings right here. And I won't have time to go in that on this video, but we'll save that for a next video. But you could play around, change some stuff, see what pops up. So that's one way that I check for sector rotation. Another neat way that I actually found from Twitter, surprisingly, is through TradingView. And a lot of people use TradingView for charting, for online charting, right? I actually use this sometimes too, especially for like cryptocurrency and whatnot, but I'm not going to focus on the charts here. This is something that I found out through Twitter, like I said, but I didn't know about it. So you go the main page, right, tradingview.com, you go to markets, you go to, what am I going to? Okay, stocks. You go to stocks, and then you go down here to the sector and industry, sorry. Okay, so now you're going to have all the sectors here. And unlike Finviz, you won't be able to see the past month, the past week, the past half a year, right? This one will really only show you the current day and how the sectors are performing today or currently. And so right now, I look around right here on change. I'll usually organize this by the strongest one, right? I want to see the strongest sector. Energy materials, right? This is the strongest sector, and it only came up 0.3, and it's the only one that's green today, right? Everything else is red, as you can see, and that's a sign. And I'll show you right here. I have CNBC opened up, right? You have the Dow Jones down, S&P 500 down, NASDAQ down, Russell 2000 down, right? It lines up, right? Because if everything's down right here, NASDAQ is down. If everything is down, then that makes sense that all these sectors are also down. You're not, it's not like energy materials is going to carry the whole market with a 0.3% change, right? So stuff like this where you just have to keep looking and really paying attention to what's happening in the market, right? There's more to the markets than just red and green candles on a stock chart, right? So it really pays. It literally will pay for you to do your homework, do your research, study the movements. You notice something, write it down. You notice something's off, write it down. You made a good call, write it down. Right? You need to build a sort of database that you can refer back to of your mistakes and your successes. Right? So that's it for today. I'm sorry for the length of the video. There is a lot of information that I really don't want to, pass up. But thank you for joining us for the video, and we'll see you in the next one. Thank you.